On the face of it, looks like a great result. There is a lot of noise in the result because they're stripping out the UK banking business, which they've obviously got rid of now, so we need to adjust all the prior periods for that. But looking at all of it on the same kind of continuing operations basis, the company is reporting cash earnings of $3.310 billion for the first half. On the same basis, that's 4.7% higher than our forecast of $3.16 billion. They've declared an interim dividend of 99 cents per share, fully franked. This dividend is unchanged from the last two dividends that were paid last year. It's equating to now a payout ratio of 79% on a cash EPS basis. They will be offering a dividend reinvestment plan, but no discount to the share price will be offered there. The main reason for the beat to our numbers looks to be much higher net interest income. The net interest margin looks like it's come in 10 basis points more than our forecast, and that's a very big beat. On the NIM. It's the Australian banking business where the NIM has really gone up. So it looks like from second half 15 to first half 16, the net interest margin in the Australian banking business has increased by 9 basis points. In the New Zealand bank, it went backwards. It's gone down by about 11 basis points. Overall, the NIM increased by 5 basis points from second half of last year to first half of this year. But some of these movements are very intriguing. So if I drill into the NIM movements very quickly, it looks like that the 5 bips increase in the NIM, half and half, is resulting from a 5 bips increase in lending margins, a 4 bips increase in deposit margins, and there's 3 basis points coming from markets and treasury. The markets and treasury is likely to be a one-off sort of benefit, but what's intriguing is the 5 bips increase in lending margins and 4 bips in deposit margins. We were expecting the likes of Westpac and CBA to benefit the most from home loan repricings, which came through last year. And whilst NAB does stand to benefit a bit from those repricings, a lot of that looked like it was going to be offset by them competing more aggressively in the SME space. So these moves are very surprising, and I'm yet to drill into it further, but I'll keep all of you posted on this. The other point I'll probably highlight is the bad debt charge. They've reported a bad debt charge of $375 million. Now, that's a bit higher than what we were expecting on the same basis, but you might recall that one of our read-throughs from the Westpac result was that just from the perspective of Westpac's provisioning for its 4 large exposures, it wasn't too difficult to arrive at a bad debt charge figure of $550 million for NAB in the first half. But their 375 has come in much lower from that point of view. So on the face of it, at this stage, I would say on the face of it, it does look like they're under provisioning relative to some of their major bank peers, particularly for some of these single name exposures. Also on asset quality, it looks like there's been further increases in impairments from New Zealand Dairy. So you might recall in the first quarter or the December quarter, they recognised $420 million, 420 New Zealand million dollars of new impaireds from New Zealand Dairy. That's now gone up further. It looks like they've taken another $102 million of new impaireds there from New Zealand Dairy in the second quarter or the March quarter. But it doesn't look like they're really raising any specific provisions there at all because they're continuing to expect no losses. So overall, it looks like a good result. It's beaten our number by 4.7% on the same basis, like I said, but I've got some doubts about the quality of this result at this stage, particularly on the net interest margin and the asset quality.